All right, welcome. Today we are diving deep into a true masterclass. Tony Robbins, Money, Master the Game. So picture this, it's right after the 2008 crash, and Tony sets out on this incredible mission. He decides he's going to interview 50 of the absolute sharpest financial minds on the planet. We're talking Warren Buffett, Ray Dalio, you name it, to figure out the real rules of money and then share them with the rest of us. So let's get into it.
And you know what? That's exactly what the financial world feels like, doesn't it? It's this dense, confusing jungle. It's full of these hidden traps and predators lurking around every corner. And the path forward, well, it feels like it's been hidden on purpose. It really feels like you're always playing at a disadvantage.
I mean, if you've ever had that little voice in the back of your head, that nagging feeling that the whole thing is kind of stacked against you, you're not wrong. You're not crazy. The system just isn't built for the little guy to win.
There's this powerful metaphor in the book that just nails it. Think about a wild beast out on the savannah. It's scorching hot, it desperately needs water to survive, so it has to go to the watering hole. But it knows that just under the surface, the crocodiles are waiting. Well, guess what? We're the wild beast. We have to invest to survive financially, but that watering hole, it is filled with hidden dangers.
So, how exactly is this game rigged? Well, it's built on a foundation of some really powerful myths. These are ideas that sound totally reasonable on the surface, but they're actually designed to do one thing: separate you from your money. And we are about to tear them down, one by one.
Let's kick things off with myth number 1. Fees. They always tell you, oh, it's just a small percentage, just 1 or 2%. But what they don't talk about are all the hidden charges, trading costs, administrative fees, the whole shebang that really add up. Forbes actually did the math and found the average true cost of a mutual fund is a jaw-dropping 3.1% every single year.
So what does that 3.1% fee actually cost you? It's staggering. Over your investing lifetime, those tiny little fees can eat up to 60% of your potential returns. Yeah, 60. Let that sink in. You take on 100% of the risk, but the house can walk away with more than half of your winnings.
And then we have the second big one, the myth of the superstar fund manager. We're sold this story that these financial geniuses can outsmart the market and get you amazing returns. But the data? Oh, the data is just ruthless. Study after study shows that more than 9 out of 10 professional managers fail. They fail to beat a simple, cheap index fund over the long run.
The legend himself, Jack Bogle, the founder of Vanguard, he knew exactly what was going on. So why do we keep falling for it? Simple. It's a fantastic sales pitch. We all want to believe that we've found the next investing wizard, but really, most of the time, we're just paying way more in fees for way worse performance.
Now this might be the most dangerous myth of all. It's the one that convinces us to gamble with our future. But what Tony Robbins found was that every single master he interviewed, every single one, had a common obsession. They are laser-focused on not losing money. They know the key to winning is just staying in the game.
Okay, so if those are the myths, what's the solution? Well, Robbins went out and found the unicorns of the investing world, that tiny, tiny fraction of people who consistently win, to find out what they do differently. And trust me, what he learned changes everything.
This isn't just some catchy phrase from Warren Buffett. It is the core philosophy. It's a complete shift in mindset. See, amateurs are always focused on how much they can make. Professionals, the masters, they focus on how much they could lose. And it makes sense, right? If you lose 50% of your money, you have to make a 100% return just to get back to where you started. The math is brutal.
So how do they do it? How do they avoid losing money but still get these huge returns? They hunt for something called asymmetric risk/reward. It's actually a pretty simple idea, but it is so profound. You look for opportunities where the potential upside, the win, is many, many times greater than the potential downside, or the loss.
The legendary investor Paul Tudor Jones basically lives by this rule. He will only make an investment if he thinks he can make $5 for every $1 he's putting at risk. I mean, just think about how powerful that is. With a 5-to-1 ratio, you can be wrong 4 times in a row, be right just once, and you still come out ahead. This is how the masters play.
Okay, so the philosophy makes sense, but how do we actually apply it? How do we build a portfolio that can handle anything the economy decides to throw at us? Let's take a look.
This was the question that completely obsessed Ray Dalio, the founder of Bridgewater, the biggest hedge fund on the planet.
He knew that trying to predict the future is a fool's game. So instead, he built a system that just doesn't have to.
What Dalio figured out is that all the wild, unpredictable swings in the market are really just driven by two simple things. Is economic growth going up or down? And is inflation going up or down? That's it. This creates just 4 possible environments, 4 seasons that our money will ever have to deal with.
And so, the solution is just brilliant. You own a mix of things where something is always doing well in every one of those seasons. When growth is booming, your stocks do great. When growth is falling, your long-term bonds are there to save the day. When inflation rears its head, you've got gold and commodities. By having something for every season, you're always prepared.
And here it is. This is the secret sauce. A typical 50-50 portfolio of stocks and bonds, it's not balanced at all. Why? Because stocks are about 3 times riskier, or more volatile, than bonds. So your risk is actually like 95% in stocks. The all-seasons portfolio doesn't balance the dollars, it balances the risk from each of those asset classes. That gives you true diversification and a much, much smoother ride.
So, we've busted the myths. We've learned the strategies from the masters. We've even looked at a blueprint for a portfolio that can weather any storm. But Robbins pushes us to ask one final, and maybe the most important, question of all.
You know, after all the saving and the investing and the compounding, what's the point? Really? Is the goal just to be the richest person in the cemetery? The masters that Tony interviewed, they knew the answer to that was a huge, resounding no.
This is the ultimate prize. Money isn't the goal. It's just a tool. It's a tool to create a life filled with incredible experiences, a tool to take care of the people you love, and a tool to leave this world a little bit better than you found it. That right there is true wealth.
And this brings us right to the final and most profound lesson in the entire book. The science on this is crystal clear. We get more lasting happiness from spending money on other people than we do on ourselves. The ultimate fulfillment in life doesn't come from what we get, it comes from what we give.
It could be anything. Maybe it's finally automating your savings, or sharing what you just learned with a friend who needs it. Or maybe it's as simple as buying a coffee for a stranger. Wealth is built by taking action. So, the only question left is, what move are you going to make?